Hi everyone, welcome to my channel. In this video, I am going to talk about what are the things that commercial lender looks for a deal. Like when you want to buy a commercial property, for sure you want to borrow money, right? If you want to borrow money, the first question that you're going to look into, will my lender lend for this deal? If the answer is yes, of course, that makes a lot of sense, right? You would go ahead. But if the lender saying no, then you cannot purchase. So in this video, I am going to uncover like what are the things that the commercial lender looks so that you make sure that is there in the deal so you can go ahead. So let's look into it. Alright, so the first thing that the commercial lender looks into in a particular deal is what is called ICR, interest coverage ratio. So what does it mean? It means that the rent that you will be collecting and net rent in commercial property, I'm talking about, if you collect let's say 100,000 rent, the lender is going to look into is that all right, for the amount of money that you are borrowing, will you be able to pay the interest for that money? Because after all, the lender's number one question to you is, I'm lending this money to this person's entity, how I'm going to get the money back? That's the only questions they have. For that, they will go every nook and corner and try to find out, protect themselves, that as long as you prove themselves that yes, you will be able to repay, they are going to lend you lots of money. So the first thing that they're going to look is the interest coverage ratio. Interest coverage ratio, simple calculation is 1.5 times. How it does happen? Better example would be 120,000 you are collecting rent, divide by 1.5, which is 80,000. What you're going to look into, as long as the yearly interest for the amount of loan that you are taking, the interest payment is below 80,000, they will say fine, go for it, and they would lend you. So on the ICR ratio or the interest coverage ratio basis, as long as the amount of rent that you're collecting divided by 1.5 is 80,000, they will do. Now again, this 1.5 is not fixed, it's variable. It depends on what's the interest rate, what's the situation, what's APRA is actually guiding them. There are a lot of other factors, but I'm just giving you at the time of recording this as a benchmark so you understand how does this work. Remember, this is the net rent that we are talking about, and as long as you are within that 80,000 with 120,000 rent collection as in your interest payment, is something that lender will be very happy right now. The second thing that the lender looks into is that how long is the lease, or what is the WALE, weighted average lease expiry, for that property, for that deal. If it is generally speaking about more than 3 years, then lender will be very happy. If it is between 2 to 3 years, it depends on the scenarios, they might agree that as well. But if it is like a less than 1 year or 1 to 2 years, they might get nervous. So when you're buying or looking for a deal, make sure the lease is little longer. If it is more than 3 years, well and happy, I think almost always you will find that there is a lender who is ready to lend you with a longer lease. More than 3 years lease is considered a longer lease. On the other side, if you are trying to buy a deal where only 6 months left or some portion of that property is vacant, is where the lender can get nervous. So when you are looking for a deal, you always check that how long is the lease left and ask yourself this question, is my lender going to be happy with this many years lease left? And that WALE, which is weighted average lease expiry, as long as it is longer than 3 years, for sure your lender is going to be happy. So look for that as well, and then only decide to go ahead with that property. The third thing that the lender is looking into is the tenancy. Who is the tenant? Remember, if the tenant is strong, so in other words, a national tenant or ASX listed tenant or even international tenants, they will have more weightage than a mom and dad tenant or somebody who just started doing the business. I'm just giving you the comparison. So when you're purchasing a deal, and if you have like two deals, one has with a strong tenant, a little bit of lower cash flow, and another one is not so strong tenant but little bit higher cash flow, sometimes it's better to go with this lower cash flow but a strong tenant, because the lender will love it and they will lend you money, than knowing is a mom and dad tenant and that might get rejected as well. Now there are other components and other factors also need to be considered, but just on the tenancy basis, the stronger the tenant, the likelihood your loan is going to be approved and your lender will love it. So look for who is the tenant, how long they are doing the business, what is their reputation, how many branches do they have like as tenancy, and as long as they have multiple branches or they have been doing the business for long term or they are ASX listed tenant or an international tenant, or they have places even within the state, multiple places they are operating, for sure that lender is going to love it, and you of course can demonstrate that to your lender as well. And the reverse is also true. Somebody who just started the business, their ABN number is just got formed 6 months ago, then that's why your lender might get nervous and might reject your loan. And last but not the least, lender's overall question is very simple. What is you as a landlord, what is your capability to pay off the loan? What is your capabilities, so that they can determine that, hey, if I lend money to his entity or her entity or him, how is going to repay? Because as long as they are getting their money back, they'll be very happy. So lender risk is always that, okay, how would I get our money back? And if you can prove, if you can demonstrate for very different ways, lease, your tenancies, your cash flow, your own ability, for sure you are going to get the loan. But if lender gets nervous of any of these points, that's how they are going to knock back. That's how they are going to be saying that, oh, you will not lend you because we see that you're not. And that is exactly what you see, that after buying 2 or 3 or 4 residential properties, the lender said, no, we are not going to lend you anymore because you are buying all these negative cash flow properties which is not making money, so you're only relying on growth, and if it doesn't get that growth, then you will be struggling. And if you, for some reason, God forbid, if you lose your job for 3 months, 6 months, then you're going to struggle. So lender is going to get super nervous on that. On the other side, if you are buying high cash flow properties, if you have a strong tenancies, if the lease is long term, for sure lender is going to throwing more and more money to you, and you would be able to buy commercial properties. I hope this gives you some clarity, some idea about what are the things that lender looks into whenever you want to borrow money from the lender. Thank you so much for watching, and I will see you next time. Bye bye.